Hey, welcome to the Enigma Roundtable. Today is the 27th of June, 2022. Have our special friend, Luc Van Hof, with us, who's running the Enigma Trade Alert service. So welcome, Luc. Nice to have you back as always.
And then, Thank you, Tom. Glad to be here.
Before we go too far into it, just a normal disclosure that Enigma is not a broker-dealer investment advisor. For educational purposes only, options, futures, bonds, and currencies involve risks that are not suitable for all investors. Past performance is not necessarily indicative of future results. If you want to read the whole disclosure, just pause the recording or go to the bottom of any of our web pages. And I also have an attribution slide. So if you see screenshots from any of these providers, OptionNet, OptionView, Thinkorswim, Interactive Brokers, or more, we give our thanks to them for helping us do our trading better.
Okay, super. Well, welcome everyone to this Enigma Roundtable for June 27. What I have prepared for today is actually, because it's what we call a public meeting, so not only for the subscribers, but everyone interested in the Enigma strategy. I have, first of all, a short PowerPoint about, I think, 19 slides, but we'll go over them quickly so that we'll discuss and describe the strategy in more detail. And then we'll talk about account size, leverage, risk profile, and then some news with regard to the auto trading. And of course, we'll finish off with the Q&A as usual. So let's start with the trading strategy itself, Enigma. So most of you, of course, are already familiar with it, but for these people who are new to it, I think it's useful to just give a quick overview of what it is. So it's actually a trading approach which has been developed specifically for the US market, US equity market. So it has not been traded on other markets. It has been tested on other markets, but the results are not as good as for the S&P 500. So that's why we stick to that market only. As you'll see, it's 100% systematic. It's unbiased in terms of the market direction, and it's very transparent. So positions are all very clear and simple to track. So I'll talk briefly about the philosophy behind the strategy, then about the strategy itself, of course, then the three trading engines that basically generate the trading signals, a few words about the trade size and the products that we use, and then, of course, I think most interestingly is the examples for positions as a function of what kind of market environment we are in. And I'll show some performances for good months and bad months in bear markets and bullish markets. Then, of course, something about risk management and some performance data. And to finish off, a couple of reasons why it could be useful for people to look at Enigma in more detail. So first of all, the philosophy is very clear. I think it's very tough to predict the market. That's why we try to focus more on risk control, risk management, than on trying to predict where the market is going. So everything what we do is also tested. It's research-based. So we have, first of all, to find out if a certain idea can be converted into some code, that it can be tested, and that it turns out quite interestingly. So if not, we won't be trading it. So it's that simple. Now, the basic philosophy behind it is, of course, linked to the fact that we assume and expect the market to be not efficient and not at all times showing highly market efficiency. In other words, there will be some imperfections, there will be some anomalies that pop up occasionally, and we try to develop systems or rules or systematic approaches that try to capture these inefficiencies. And in a way, there are two types of inefficiencies. We have the so-called risk premia, when we get compensated for taking some risk that some people don't want to take. So you could also see it as a liquidity premium that can be captured. And on the other hand, something that is not so recurring, an efficiency that is caused by the market because it's like overshooting in a certain way, and that is temporarily available, but then it can be captured if you have a system that is on the lookout for these kind of things. So all this is trying to create is the basis to create some short-term, what I would call momentum-based, momentum-driven trading systems. And as everyone knows, there is no single system, no single rule or trading approach that will work all the time. So that's why I think it's useful to come up with a combination of different types of algorithms, 3 different algorithms that do something different, that look at the market either from a different point of view, first of all, but also from a different time frame. And at the same time, they will be looking at different portions of the market. By that I mean, some will be looking at, say, the day trading session, others will be looking at the continuous time, others will be looking at the SPX, others at the futures, looking at the volatility related to these markets, and so on. So by combining these various ways to study the S&P, because it's all related to S&P only, we can come up with a pretty decent and powerful combination of 3 different algos that will be used to generate trading signals. So as we will see, from time to time, one of the 3 is really shining, the others are doing next to nothing. At other points in time, depending on the market environment, 2 or 3 or the others, 2 or 3 or sometimes only 1, like for example, the hedge can be very successful when the momentum and the bias is not very successful, and vice versa. So in a nutshell, it's basically necessary to have several types of algos to generate these trading signals. Now, all of them are intraday data driven, and some of them will hold positions for a couple of hours, sometimes for a couple of days. But on average, we will have about 3-4 trades a week. So we could see a week with maybe 10 trades. We could see a week with only 2 trades. So that really varies quite a lot. But the essence is that we try to analyze intraday data and the short-term price movement that we can detect, and the momentum, the bias, and the hedge. These 3 algos will try to come up with some interesting signals. Now, the way to come up with these signals can be represented by the following picture. It's actually a 4-step process where we first of all try to determine what kind of anomalies or inefficiencies are available in the market on a recurring basis. Once we have that, then we will apply some statistics to find if indeed these anomalies or inefficiencies can be captured and that there is a good reason for their existence. And once we can pass from step 2 to step 3, it becomes a question of coding it. Coding it, why? Because it should be independent of what I would call the trader who is executing the trades. So we need to find, first of all, some evidence that it can be unbiased, not dependent on the person executing the trade, but that it's really some market anomaly or inefficiency that is really recurring on a regular basis and can be tested and verified by using an algo that is actually going to try and monetize the edge that should be available with that alpha. Once we have the algo and it turns out to be profitable and the drawdown is under control and it is recurring on a regular basis, then the 4th phase basically consists of trying to make it scalable. By that I mean, it is relatively easy to come up with a decent system that is being traded on, say, a very small trading size, for example, 1 contract, and be profitable. But once you start to scale it up and trade it in bigger size, maybe 20, 30, 50 contracts, E-mini S&Ps, I mean, then it should still be profitable. If it's only profitable in a very small, tiny way, then of course it cannot be used because it's not scalable and not many people or not substantial size can be traded. And that's a very tough phase to actually get through. So in many cases, we see number 1 and number 2 being met. The algo then in some cases detects that it could be a coincidence that something has been happening for the last 3-4 months. But if you test it back, say, a couple of years and you have hundreds of trades, it is really not coming through as you expect. So it's basically being dropped, the trading idea. But if it passes phase 3, it still has to go through this 4th hurdle which is really difficult, and to verify if it can be really traded in bigger size. But once we are there, of course, we could look at the contribution of a new trading idea into the portfolio. But so we ended up with 3 different types of trading engines, these so-called algos. One is momentum driven, one is what I call a pattern recognition, it's a decision model, and the third one is what we call the hedge. Now the momentum is the cleanest to that extent, or in that sense, that everyone can instantly imagine what it is going to do. It's trying to find or detect some price movement, directional movement that is strong enough so that we could call it a trend, be it a short-term trend, which will hopefully be available for a couple of days. As we've seen recently, the big down move, now a big up move. So these kind of things that last maybe 3 days or even 10 days occasionally. So that's pretty obvious, and we have several rules and principles to try and detect these significant directional movements. But the second one, the bias, is slightly different. Of course, it also tries to detect, call it a trend, be it a shorter term trend, because it's looking at a more granular data set. So it's looking at very tiny intraday data, and it's looking at volatility, and it's looking at the SPX versus the futures, things like that. But it then doesn't really try to predict where the market is going. It's simply trying to classify if we are in a certain mode. And with mode, I mean, are we in an up mode or in a down mode? So once it can go beyond a certain threshold, the threshold which is to be determined to see if indeed the move is significant enough so that we have really a strong enough signal, then it can go to the second phase, and then we're only waiting for some confirmation. So if we have like a buy decision, to take this example, because in most cases, the bias, the second algo, is looking for long signals. It's only rather exceptionally that it will also try and find some short signals, as it is doing now, for example, since a couple of, I think, a week or so. But in the majority of cases, it is predominantly looking for long trades. But assume it's looking for a long entry, then it first has to pass this first layer and see if indeed the strength, the upward price movement is strong enough so that we could classify it as, okay, this is an upward movement. But then we still need some additional confirmation, which has to happen within a certain time window before it will generate a trading signal. So it's very selective in terms of firing or generating trading signals. But it could go in the same direction or in the opposite direction as the momentum. The momentum could, for example, be going short, and the bias could be going long a couple of hours later. So that's definitely not exceptional. Then the third one is very different from the 2 others. Of course, the 3 are all different from each other. If not, it wouldn't make too much sense to include them. But this third one is really trying to detect some what we call tail risk events, some short-term overshooting in one direction or the other. So it could be going short when the market is actually going up, or it could be actually going up when the market is going up. So it's really dependent on what we are seeing. And it is trying to detect, first of all, some extreme price moves, and it looks for that at what has been happening intraday. So not so much what has been happening for the last week or for the last 3 days, but it's mostly a very short-term overshooting in terms of price movement. Now, what is peculiar with this third algo is that it's always going to switch positions from one direction into the other. So in other words, it's going to be long and then it's going short. It's never going to be flat. So it's always in the market, and as such, it will, in most scenarios, actually act as a hedge, hence the name, for the other 2. So at times, it can be, of course, that it is the only one which is active and the only one which has still a position on, as is the case, for example, right now as we speak. Because the 2 others, the momentum and the bias, they can go flat. They can go long or short and then exit the trade without reversing, while the hedge is always taking a position. And so it can be that it's the only system which is active at one point in time. Now, to tell you a little bit more, with regard to the trading size, if we bring these three algos together, of course, we can end up with a very big bullish position or a very big bearish position. So we have structured it in such a way that we can never exceed a certain size. And by size, I mean a number of units. So one unit, what we use now is 1 micro E-mini S&P. And in the standard setup, we will be using now 2 contracts, micro E-minis, so MES, per signal. In other words, let's assume we have a long signal from the momentum, we will be buying 2 contracts. If we have maybe a couple of hours later, another long signal, say from the bias, well, we will be buying an additional 2 contracts. So we end up with 4 micro E-minis. And if at the end of the day, the market is really extremely bullish and we could see some tail risk event developing, then we could actually be shorting some contracts, actually 2 contracts again, from the hedge algo. So we could end up with 4 contracts, we could end up with 2 contracts, we could end up with 6 contracts, depending on the relative weights between the 3 algos. Now, in most scenarios, we will have an equi-weighting, in other words, 2 contracts, 2 contracts, 2 contracts for each algo the same. But in certain conditions, certain market conditions, it could be that we will be giving more power, so to speak, to the hedge algo, or more power to the momentum algo, or more power to the bias one. What we will see at all times is that each of the 3 will be there. So it's not going to be a situation where we say, well, let's forget altogether about the hedge, or let's forget altogether about the momentum. We'll only trade the bias and the hedge. That's not going to happen. So the system has been developed in such a way that the 3 will always be participating. It's a bit comparable to saying, well, if I'm trading a long equity portfolio, we'll always have some position in bonds. So we'll never be totally out of the fixed income market or out of the equity market. In a similar way, we will always have a potential trade with one of the 3 algos, and it's never going to be the case that one of the algos is going to be eliminated, so to speak, from the portfolio. But so that basically means that in this extreme scenario where the market would be, say, going down, let's assume the market is going down and we get, say, a short signal from the momentum and we have no signal on the bias, so we would be short 2 contracts. If the market is really going down strongly, as we have seen lately, I mean, about a week ago, then what could happen is that the hedge algo is going to buy. So in other words, now we are long 2 contracts from the hedge, and we are short 2 contracts from the momentum. So the net position is going to be flat. However, it's virtually impossible that these 2 trades are going to take place at the same time. So in the majority of cases, we will have scaled into the trade first short and then covered it by buying some contracts using the hedge algo. Now, if the market starts to rally, as we've seen over the last couple of days, then the short momentum trade will probably be exiting its position, which is actually what happened. So we took profits on the short momentum trade and we were still staying with the long hedge. So then we had no position in the momentum algo, we had no position in the bias, but we still had a position in the hedge. So we could end up with 2 contracts from the hedge only. Now, assume that the market continues to go up, it is really quite logical that then we could see a long trade from the bias and or a long trade from the momentum, which could result in a long position in total of up to 6 contracts. So in the extreme positive scenario, we could be building 6 units long, and in the extreme negative scenario, of course, we could have 6 contracts short. And you'll see at the bottom of the page the distribution. In other words, it's not going to happen very frequently that we will be long 4, 5, or 6 contracts long. It's not going to happen very frequently that we will be short 4, 5, or 6 short. The majority of cases, it's going to be 0 or 2 contracts long. Actually, the average, the weighted average of all these positions and combinations is about 1 contract net long. So you could compare it, and that's why we compare it to the S&P, because in a certain way, this is a system, a strategy, which has as an objective to try and beat the S&P market. So it should be able to track it, if not improve the performance. So we compare it by having an average position of just one micro E-mini S&P. However, it's going to be rather exceptional that we have exactly one contract long. It happens about 6.6% of the time, but we could be flat. We could be long 2, we could be long 4, we could be long 3, we could be long 6, but not very often. And we could be short, of course. So the real power of the Enigma trading strategy lies predominantly in the fact that it's very quick at switching from long to short, from short to long to flat, and so on. So it's basically doing some, call it advanced market timing, and adding to the position or decreasing the position, or just going flat if needed. So that's really the key concept behind the Enigma trading product. Now, if you look at a couple of examples, I brought 3 months here. One is November 2020. And I think most of you will remember that this was an exceptionally strong month. It's actually one of the strongest months in the S&P we've seen in the last 15 years. So the market in that 1 month went up 10.75%. And you see here the S&P on a month-to-date basis. So starting on November the 2nd, the market went up a little bit, nearly 2%, went up even higher, even higher, even higher. And after, say, 7-8 days, the market was already up 9.26% on November 11 compared to the previous month end. So we see this very steep rally, and Enigma actually bought 2 contracts on the first day and then quickly bought an additional 4 contracts. So we had this exceptionally long position of 6 contracts after 2-3 trading days. I think on the second trading day already we had the 6 contracts. And then it stayed with that maximum long position for 7 of the first 8 trading days. So we started with 2, then went to 6, and stayed with the 6 contracts for another 7 days. So that's really, truly exceptional. Of course, the market also was doing some exceptional performance, and that's why the system tried to catch up with that. Now, given the fact that we are holding 6 contracts compared to the average of 1, of course, we will be outperforming the market in that scenario. Now, when later the market started to not flatten, but not really continue at the same pace, Enigma was very quick at taking profits and actually built the position down from 6 to 4, one day back up to 6, and then actually to 2, stayed around 2 or 4 contracts. For one day was back at 6, and then ended the month with 2 contracts. So this kind of switches is very indicative and very representative, I should say, of what can happen when the market is really changing gears, or when the momentum, the bias is changing. So it could very well be that the momentum was really very strong and then started to taper off. And of course, that's when the several positions, be it the bias or the momentum, were actually taking profits. Or it could be that the hedge, for example, said, well, this is an extreme event, let's go short. And it, of course, reduced the position from 6 to actually to 2, which is what happened here probably. So you see that depending on the type of environment, we can be very quickly very long, but then again, in 3-4 days, we can be back to nearly flat, while the market is continuing to go slightly higher or flattening out a bit. And so for that month, for example, after fees, we made 10.59 and the market did about the same thing. But remember, we were using much more leverage at the beginning. And of course, here we were only holding 2 positions instead of 6. Now, in a bearish environment, like we have in January of this year, we have about the opposite. So there the S&P was down about 9% by the end of the month, or towards the end of the month, I should say, on January 27. The market was down 9.22. And Enigma was actually starting the year slightly bullish, but not very bullish. and then quickly became neutral to bearish. So I think it's about January 10 or January 11, we would be short 4 contracts, then went back to flat and went back to -4, and we're basically flat or negative most of the month. Then at the end of the month, when we saw this hesitation, the system actually went very strongly long, which was a bit too quick, I think, and then went back to flat and ended the month then with +2 contracts long, while the market was recovering a bit from the minus 9.22. So the S&P ended the month down 5.25, I should say, while it had been down as much as 9 or over 9%. And so we made about 3% after fees in that month, while the S&P was losing, or basically losing 5%. Now this looks fantastic. In a bearish environment we make money, in a bullish environment we make money, but what's happening if it's not really very clear? And this is a very good example, I think. The month of May 2021, nothing spectacular, nothing very in particular in terms of market movement. Well, it's a very bad month for Enigma. Why is that? Well, because it's trying to detect some trend, and if the trend is not really materializing, it's not really being confirmed, it's going into a trade. Like here, it went short. The market really didn't go down very much. Then it started to go positive, actually held 4 contracts long. The market was actually coming down, so it reversed from +4 to flat, went back up to even 6 contracts, then went from +6 to -4, from -4 to +6, so it was chopped up completely, while the market was going down from, at one point in time, up 1% or slightly over 1%. Yeah, 1.23 was the high I see, down to -2.83. So not a huge range, about say 4% in total as a monthly range, which is not big at all, while Enigma got short very much, -4, which is very bearish, to here +6, which is extremely bullish, to again very bearish, to extremely bullish, and ended up the month with nearly 6% losses. So that can happen as well. Why? Because it's very risk averse. That's how it has been built. So it will extremely quickly try to adjust the position when something is not being confirmed by the market. So in other words, when we are long and the market is going to go down, it's rather fast in terms of exiting the trade. If then the market continues down, it's probably going to go short. If then the short doesn't continue, the short move, then it's going to exit again. So it could be getting chopped up rather dramatically in these kind of environments. So these kind of months will definitely be part of the game and are very difficult to avoid. But that's in a way the price we pay for being able to switch quickly in and out of a trend. So risk management, of course, is what we focus on first of all. If we have bad risk management, even if you have a good trading idea, we will be losing money at the end. So it's really the first thing we can control. And why? Because it's the only thing we actually can control. Not only it's the first thing we should look at, but return is purely and uniquely the choice of the market. So what we try to build is some, what I could call convexity. So getting more and more long in an up move, or getting more and more short in a down move, which is basically mimicking the behavior of options without using options. So it could be buying an out of the money option, which has a delta of say 15, minus 0.15. And then if the market indeed starts to come down, as we have seen recently, then that same option could turn into a delta of minus 0.6 or minus 0.8. And of course, we are longer, we are more and more mimicking the behavior of a long put position, and vice versa. When you're adding to the position, we will be, to the long side, of course, we will be mimicking long call positions. So it's building this kind of convexity into the strategy. And that's what we try to do using risk management. And risk management in the sense that we are using, of course, tail risk hedging with the third algo, the hedge algo, and that we focus most importantly or very significantly on what could be described as position sizing. So it's not so much the exact price where we enter, it's more the trading size in combination with the price, of course. So we look a lot at the options market, so the SPX, which is key for us, the spreads, the volatility, the skew, things like that, to come up with rules to translate them and convert them into futures trades. So that's in a nutshell the risk management that we use. And so the diversification we use in terms of instruments, why we're only trading S&P, how can we say that we are using diversification with instruments? It's because we're looking at different markets which are connected to the S&P. And by that I mean the cash market, the futures market, the options market, and so on. Looking at different temporal slices, in other words, the regular trading session, the continuous market, and the fixed market, which of course has another time frame for trading than the regular trading hours, and also different from the continuous Globex market. So all these different time frames come into play to come up with the trading signals. Now, the trading signals themselves, they will only and exclusively be generated during the day session. So it's not so that during the night there could be a trade that we should go long or short or exit the trade. That's not going to happen. All the trades are done only during the regular trading hours. So between 9:30 Eastern and 4:30. Actually, at the cash close, we have the last potential trade. So by 4:15, it's definitely done with, but we could see a trade at the end of the day. And in terms of risk management, we talked about that. So we try to focus more on preventing very big losses, not so much on trying to avoid volatility, because we need volatility actually to be able to build positions, and sometimes relatively big positions, significant positions, to have this extra leverage, but we will be quick to scale out of it when the market is not going our way. But so we try to avoid significant losses. Now, portfolio construction has to do with effective diversification. We are not trying to find low correlation. So it's not so that the correlation is at all times very low between the three algos. Sometimes they are highly correlated, especially the first two, momentum and the bias. The hedge is usually negatively correlated, but it can be at times positively correlated. For example, when they go all three long or all three are going short, they could be for several days be highly correlated, in other words, going in the same direction. But we are using different methods and different time frames to build the trading signals. Then the position sizing, as I explained earlier, is really the key. So how to scale up from 1, 2 contracts to 3, 4, 5, 6 contracts. That's actually the power of the system. Now, if you look at performance, it's highly dependent on what kind of leverage we are using. And that's why I would like to devote a bit more attention to this leverage or account size later on tonight. So this is an example of where we are using 150% maximum exposure. And I will try to explain what I mean by that. So for that, I will actually go to the piece that I prepared here. So when we talk about account size, leverage, and risk profile, I'm missing the D here. So we can say that the risk profile is really key in terms of how are we going to determine our optimal account size. So everyone has a different risk profile, potentially. So we only need to answer one simple question. So what is for you the acceptable maximum drawdown? Once we know that, we can actually construct a portfolio which is actually going to be very correlated to that acceptable maximum drawdown. Because we know it's a clear fact that the higher the maximum drawdown that we can tolerate, that we can accept, the higher the risk profile that we are comfortable with. So the more aggressive, the more dynamic, so to speak, our trading can be. And of course, the return should be correlated to this higher drawdown acceptancy. In other words, if you are prepared to lose more, you should be compensated for that willingness to be able or be happy, or not happy, but be comfortable with accepting this potentially bigger drawdown. And this payoff should come in the form of a higher expected return. So there is a big correlation between a higher risk profile, a higher drawdown, and of course, higher expected return. So I've made 2 examples. I'm showing 2 examples. One is what I call the very conservative investor. who says, well, I can't really accept a maximum drawdown more than 10%. And this 10%, of course, needs to be defined or described more precisely, but because what is a 10% drawdown? How are you going to measure it? First of all, we will be measuring it using closed trades, because we could be using open trades, but that's complicating things because within the day there could be a lot of changes within the portfolio. And of course, it's much easier if we do historical verification that we look at the closed trades only, and then of course we bring the three algos together. So first of all, we look at closed trades, but then we could look at daily returns or a daily analysis, or we could simply look at the month-end results. If you are a conservative investor, let's say a family office or a pension fund, assume that, you could say, well, I'm going to do this for a long time. I will be looking at the market not every single hour, let alone every day or every week. I will be studying this, say, on a monthly basis, but I don't want to see a month where or don't want to see return numbers when these return numbers, which are using monthly data, will lead to a drawdown which is bigger than 10%. So that's actually the criterion I'm using here. So in other words, let's assume we have an account size of $40,000, and it'll become clear why I'm using this 40,000. And we say, well, let's use a 150% account size. That basically means that we could theoretically, as a maximum, an ultimate position in the market, see something as big as 60,000. That's what we are willing to accept, so to speak. And how do we arrive at that? Well, if the ES, so the E-mini S&P would be at, say, 4,000, of course, we're not exactly there, but we're not 3,905 for the moment. So assume it's at 4,000, one ES, of course, would represent 200,000 US dollars at $50 a point. Of course, one micro would then represent 20,000. Now, we know that, going back to this slide, we could have a maximum of 6 contracts long or 6 contracts short. Then we know that, okay, if we don't want to go beyond 150%, i.e. 60,000, we can never trade more than 3 contracts. Because if we have the 3 contracts long, or the 3 contracts short, we would have some notional exposure of 60,000 long or short, which would equate to 150% of the account size that we have. So the Enigma trading size that we then would be using would be a very simple and the minimal trading size 111. The 111 being 1 in the momentum, 1 in the bias, and 1 contract in the hedge. So we can't trade less than that because, as I said earlier, we can't really exclude one of the 3 algos because that would be basically destroying the potential of the strategy. So we need the 3 at all times. So we can't trade less than 1 contract in each of them. So in that case, we will be trading 3 contracts maximum if they all 3 go in the same direction, which again is rather exceptional, like only 8.8% of the time, or 2% of the time, all 3 of them are short. But say then, we could be long 3 contracts at 20,000, so 60,000, and we will be showing the 150% maximum exposure, or 1.5 times maximum leverage. That's the cap we have built in terms of leverage. So what are the numbers then? If you would be doing that with 40,000 and at times be using 3 contracts, so all 3 of them are long, all 3 of them are short, we could be having this position of 3 contracts maximum, long or short. We would end up with an average, a CAGR, a compounded annualized geometric return, of slightly over 24%, so 24.38, which is after transaction fees, but before other fees. So the trading costs are deducted, the spread is being deducted, but other fees like management fees, performance fees, in this case, of course, subscription fees are not yet being deducted. So if we deduct the subscription fees of, say, $1,250 per year, then we would end up with $8,500 as the expected net return after trading costs and after fees, which would equate to about 21% on the account size. So 8,500 on the 40,000. Now, what is a drawdown? Because it was actually our starting point. And in that case, if we look at the monthly returns, and that's an important thing I want to mention. So we're looking at the monthly return data, we would never see a drawdown which would be bigger than 8.3%. However, if you look at the daily returns using closed trades, it would be about twice as much. So you would see, that's why I put here the maximum daily drawdown of 16.1. But say an investor who says, well, I will be calculating my drawdown looking only at monthly return numbers, would never exceed the 10% going back to January 2006. Now, another important feature is the risk. Standard deviation, volatility, in other words, of the return is about the same as the return, about 21%. So we end up with a Sharpe of slightly above 1, so not dramatically higher. We have a downside deviation, which is really low, about 12%, so that's a good thing. So the negative or the surprises are usually positive surprises. In other words, above the regression line, we have some exceptional moves. Below the regression, we have smaller moves. About 12% is the downside deviation. So the Sortino ratio becomes about 2, which is a good number. And then, of course, the maximum daily drawdown is 16.1. If you would use the monthly returns, it would be about 8.3. Now, nevertheless, we see a lengthy drawdown. I mean, it's a relative thing, but I consider this rather lengthy. It's more than 1 year that it could take to make new equity highs. So 14 months, we could be in a drawdown. That's the longest drawdown we've seen using this 150% exposure. Also, we can calculate what is the likelihood of after a year being underwater. In other words, being at a lower net asset value than where we started, independent of when we started. So we look at the whole history since 2006 and say, well, how many times could we have been underwater 12 months later from the starting point? Well, that doesn't happen very often. Usually after a year you're up, you have about a 98% probability of being higher than where you started a year later. And of course, we see some more statistics in terms of also performance index, which is decent, 2.1, and then the average winning month and average losing month. Now, we make money about 2 months out of 3, which is not huge. So it's not like we are making money every month or 8 months out of 10, not at all. It's about 2 out of 3. But the good news is there that the average losing month is about half, even smaller than the average winning month. So that's, of course, helping the distribution quite nicely. Now, this bottom line for me is actually the most important one. And it's looking at the distribution of the returns and the distribution of the risk. So we have a 5th percentile CAGR of 14%. In other words, we could say we can expect to have an expected CAGR, so an annualized return, I should say, of more than 14.2% in about 95% of cases. So only in 5% of cases, we should expect to see an annualized return below this 14%. So that's a good thing. And in terms of risk, that's much better controlled than the return because it's something we can control, this we cannot. We see that it's highly unlikely that the volatility of the return, the standard deviation of the return, is going to exceed 23%. It's only in 5% of cases that we will see a standard deviation of the return exceeding 23.2%. And the ratio of these two is relatively attractive with about 60%. So if we divide one by the other, we end up with 61%. Now, similarly, we can do an exercise for someone who says, well, I would like to trade this much more aggressively and with a relatively small account, say 40,000, I'm willing to trade it with a notional exposure of 300%. In other words, twice as aggressively. Now, in terms of drawdown, it's going to have some serious implications because now this person says, well, I would like to study not monthly returns, but daily returns. And I'll be looking at closed trades, of course, but I'm willing to accept a 33% drawdown. In that case, with the same numbers for the S&P, 4,000, let's assume, we could be trading various combinations. But the bottom line is we can be using 6 contracts at most. In other words, this scenario, what we're currently using, 2-2-2, 2 with momentum, 2 with bias, or 2 with hedge, or other potential combinations like 3-2-1, 3 with momentum, 2 with a bias, 1 with a hedge, or 3 with a bias, 2 with a hedge, 1 with momentum. So that will vary as a function of the market environment, but never would we see a maximum position that is exceeding 6 contracts. So the net position will always be between -6 and +6, comparable to what we see right here. And so then we could see some pretty decent return numbers. We end up, again, before fees, but after transaction cost, after trading costs, with about 52%. The drawdown using daily data is now about twice as big, 31.2. Standard deviation is also a pretty hefty number, nearly 50%. So it's a lot of volatility in the return. But again, the good news, its downside deviation is only about half of that standard deviation. So again, the positive surprises, of course, all the surprises will be positive rather than negative. That's what I wanted to say. Of course, the drawdown is going to show similar numbers in terms of length and probabilities, but the Sharpe ratio is still about the same. Sortino is about the same. And we end up with these kind of numbers, a 29% return now with a 95% probability. And the risk is not going to exceed 55% in 95% of cases. So that's basically to give an idea of what kind of return and risk we can expect. Now, going back to this one, I think another feature which could be worthwhile is looking at the comparison between the S&P and the strategy. So what is it doing when the S&P is doing something exceptional? And by exceptional, I took the 10 best months in the S&P since January 2006, and you see them listed here in declining order. So going from the biggest gains to the top 10. So from the biggest month, which was April 20, market rallied 12.68%, to August 20, the market rallying 7%. So what did we do with Enigma? Using the same feature, the 150%, of course, not the 300%. So in that month, same month, we didn't make 12.68, we only made 3.5. In October, the second biggest month, 10.77, we only made 0.7. And the one we looked at earlier in detail, we basically matched the performance. So it's rather the exception than the rule. In most cases, we will underperform the S&P when the S&P has a really strong month. So we could see something similar like in March 09 or like in November 20, but in the vast majority of cases, we will be about doing half as much as the S&P. And if we add it all up, the 10 best months ever since 2006 would represent 91%, so about 9.15% on average for the S&P, while in the same 10 months, we would be doing about half of that, 4.77. And we see in most cases, we cannot track the S&P if it is really having a very good month. Now, the flip side of that is, what if you looked at the 10 worst months of the S&P since January? Then we see, of course, October 08, we see March 20, February 09, December 18, September 08, all these months going from -16.94 to -8. And then we see some surprising news, like in most cases, we'll be making money. Not all the time, but in about 80% of these. So in 8 cases out of the 10, we made money while the S&P was losing big. Only in May of 10, and this was of course linked to the flash crash, and in December 18, we did not make money. But all the other months, we had pretty decent performance, especially in March 20, of course, when we had our biggest month ever with 54%. But so the lesson here, or basically the takeaway, is, well, even if the S&P is doing dramatically bad, -10% on average in a month, we can make some serious money, about 7.8 on average during the same period. Now, this of course results in the correlation, And if you look at the correlation, and I've studied correlation or analyzed it using two lookbacks, a look back of 12 months and a look back of 3 years. So in other words, taking the last 12 months and comparing those with the same period for the S&P, we can see that if you look at the longer correlation, say the blue line here, it is usually tracking it pretty decently. But if you take the average, it's only 0.07 on the 36 months, while occasionally it can be as high as 0.53, and occasionally it can be as low as minus 0.55. Now, if you look at the short-term correlation, so measured only over 12 months, it can be all over the place. It can be very highly correlated, as highly as, say, 0.71, like we see here, or as low as minus 0.69. So it's going to be sometimes very negatively correlated, like, of course, in 2020, when the market was dropping or falling out of bed and we had our best month ever. Of course, then correlation for that period will be, of course, very negative. And if the market is rallying strongly, and of course, we're making money in one of these cases, then correlation would be very high as well. But in a nutshell, we could say the correlation measured over 12 months is going to be virtually absent. So it's going to be on the median number is 0.11. Over 12 months, it's 0.07 measured over 3 years, with some maxima and minima between 0.7 or minus 0.7, and Q1 and Q3 between 0.22 negative and 0.5, I should say, for the third quartile. So the correlation is going to be absent. We will be trading the S&P, but without any correlation on average. Of course, our position will be around one S&P contract, on average 1.06, but it can be as big as +6 or -6, depending on the leverage that we are applying. And for that, of course, we need to look at what kind of risk profile we have, what kind of exposure we want to allow. Can we do 300% of the notional account size? Can we use 600% of the notional account size? That's, of course, up to the individual investor. But of course, the edge is there. The edge is there in terms of we can make some decent money. But of course, the more money we want to make, the bigger the standard deviation will be, the bigger the risk will be. And of course, the bigger the fluctuations, the drawdowns will be bigger. So it's all correlated. But all in all, we have a positive alpha, structural alpha, which of course was the objective from the start. So then I'll try to cover the questions afterwards, of course. Then a lot of people, or several people, I should not say a lot, about 10 people have asked me about auto trading the program, if they can't, for whatever reason, follow it for certain periods of time while they're on holiday, or they don't want to be able to, or they don't want to be tracking the screens during the day, or they can't for whatever reason. Well, it can be auto traded. I've spoken to Striker Securities, and this person, Dan Neenan, is willing to execute it. I think he's doing quite a good job. He has been executing several systems for me that I've tested with him or via Striker, and it's going quite well. And he can be reached at these are his contact data. So now they've provided also at Striker the possibility for people to contact them and say, well, I want to have this Enigma traded for me, and you can start an account, or you can tell them where your account is, and they will execute the trade and basically give up the trade into the account of the bank or the broker where you have your account. So it's a possibility that can be explored. So I think that could be a useful feature if people want to have the system traded without trading them, or without trading the alerts themselves. So I think that's all I have for the moment. Let's have a look at the Q&A.
And do you know what the commissions that Striker's charging are, just offhand?
Yes, I think it's $1.50 per micro E-mini S&P.
Okay.
That's what he told me. So 1.5 is what I got as a number.
That's each way, right? So $3
Yes,
round
yes,
trip.
absolutely. Per contract, absolutely. Yeah. No, I'm sure it's going to be dependent on the trading size, but I think that's the minimum, I think. Or the maximum, I should say, per one turn.
So how does I know what we were doing with Mark Ansel with Night Owl is people would keep their subscription with Airmere and then they would be auto trading through Striker. Is that kind of the same thing you're doing?
That I'm not sure. So that's something that we need to see with Dan. But I'm sure that that should be a possibility. And that would be for the scenario that someone would say, well, occasionally I want it to be auto-traded and occasionally I want to trade it myself. Or for what scenario, Tom? Do you have that in mind?
Well, the way we were doing it was that was complete auto trading. Striker was doing all the trading.
Okay, okay. So then I think that they should only pay the fee to Striker, and of course it should flow back to you.
Yeah, that might be complicated. I'll ask them. I'll reach out to Bill
Dan,
Gowis
yeah.
and Dan.
Okay.
Yep.
Okay. Okay.
And then did you want me to show that calculator thing I built?
Oh yes, you can. Sure. So I should stop sharing.
Yeah, I think I can share.
Or shall we cover some of the questions first?
Yeah, there's another one here about the underwater after 12 months. Did you see that?
That's exactly what Giuliano is saying. So it basically means that you're underwater after 12 months. So it's basically that. So if you start with 20K and 12 months later, you would be having less than 20K. And so what's the probability of being below 20K after 12 months, independent of where you started?
Yeah, it's a 12-month rolling period.
Absolutely. Yeah.
Okay, so I guess I'll share my screen real quick.
Sure. I'll stop here.
Oh, I think mine does stop yours automatically. Do you see it?
Okay.
Okay, so I've got this little tool I built, and I'm using multiple brokers. Striker actually isn't a broker. They used to be, but now they use Gain Capital. So
Gain Capital.
When you open an account with Striker, it's actually the futures are actually traded at Gain, and that's where I'm using the margins from. But you can pick any one of ES, MES, Spiders, or UPRO. UPRO is a 3x SP 500 ETF. So the micro ES is 5-to-1, the UPRO is 3-to-1, but it gets rebalanced every day. So it's not the same as MES as far as leverage, but it's more leveraged than SPY. So if you wanted to trade those, you could, especially in a smaller account. But just pick your broker. Interactive Brokers is the one that changes the most, and they have actually, I think, the highest commission, or margin. So an ES margin, one ES contract at IB, when I did this, I guess yesterday, was almost 23,000. But if you look at AMP, I think was the lowest is 10. So it's quite a difference. Most of them are about 11, 5.5, like Ninja. Thinkorswim's a little bit higher, kind of in between most people and Interactive Brokers. Trade-Evade, they kind of specialize in futures trading. TradeStation, those are all the same. And the MES is usually 1/10 of that. Like Interactive Brokers was like 23,000, but the MES is 2,300. And so you can pick which broker you're using, and it looks it up. I'll update this once or twice a week. And then you just say how much capital you want to put to work, and then what kind of drawdown buffer you need. And I was doing some calculations with your 31% or 31.2% drawdown. And if I think you needed a 48.8%, so just round it up to 50. So if you take your capital and add a 50% buffer, that will cover you in a 31.2% drawdown. So this calculates how much you need for one unit based on that broker and the symbol you're trading. And then, okay, so now this combination is 1 unit and you're currently +2. So you need to be +2 contracts of MES. If you're doing ES, it says, oh, you don't have enough money in here. But if you put in like 500,000, now you have enough for 3 units, you're going to be trading 6 full ES contracts based on this capital that you put in and the broker symbol combination and buffer drawdown. So it's just a way to help you gauge how many contracts you should be trading based on what symbol you're using, what broker you're at, what margin they have, and what drawdown buffer you're using, and how much capital you're putting into this system. So hopefully people find it useful.
Okay. And so the drawdown buffer is like an arbitrary number that you can put in.
Right. So if you want to be more
yes.
conservative, you could do 75% or 100%, whatever number you are comfortable with, just put that drawdown buffer. But the 50% will cover a 31% drawdown.
Of course. Yeah. Okay. That's very useful, especially because it's related to the specific broker and the instrument that you're trading. So that helps a lot.
Yeah, and like I said, they don't change them that often, but you see the data was last updated, and I have a sheet that I update it all. I go right to their pages with the links to update it, and it doesn't take me very long to do that. And most of the time, they don't change. So hopefully this helps.
Okay. I see another question from Giuliano with regard to what is the latest time for the hedge algo or any other algo. 1605, yes. After the close of the cash S&P, so the SPX, there could be a signal, and that could come from the hedge only. So the other two algos will actually fire their last signal slightly before the close of the S&P. So 1605 is a good cutoff time, indeed.
I know the options stop trading at 16:15 Eastern.
Sure.
What time do the futures stop? Is that 4:45?
Well, at 15, and then they resume at 30. So they have like a 15-minute break between 4:15 and 4:30.
Okay. But I know they're aren't they closed right now and they start up at 6 again, something like that? Are they trading right now?
Yes. So now they are 39.10.
I haven't seen it move for a while. Anyway, it's it just takes a short break and then it starts up again.
So now it just moved. Yeah. So it's now 39.10.00.
I don't see any more questions, Luc.
Okay, that's fine. Okay, good. What is the name of the system in Striker? It's called Enigma. Search ask that question. Can you repeat how we can do this in Striker? So you can simply contact Striker. So
Dan Neenan.
So shall I share my
screen? Yeah, let me stop sharing my screen.
So how can we do this in Striker? So we basically, you need to contact Striker Securities, Dan Neenan. So these are his contact data. And then you ask to basically go for the Enigma trading strategy trading system. So then you can put whatever capital and whatever trade size that you want, and they will trade all the trading signals because they will be receiving them. So now in terms of us providing them, we can use Slack, I think, or we can use text or email. So the same media that we're using currently. So I think then it's best that we can add him to the list, Tom, so that Dan and his team, because there are 2 or 3 people who are executing the trades, so that they receive it.
Yeah, I've got the 3 people because they were on the list for Night Owl.
Okay.
I think Dickerson is one of them, something like that.
Yes, it is, absolutely, and
something like that. I'll look it up. Yeah. They have logins already.
Okay, super. So they do indeed execute the trades manually. That is correct.
Right. And when I was doing it with them with Expert Signal, I had a page I built in the Expert Home that would actually email them the trades, and then they would do them.
Okay. Okay.
There's probably a little bit of a delay with them versus somebody who's a subscriber doing it themselves, but I don't think it's that critical for Enigma from what
No,
I've seen.
it should not be, because in most cases, like with the hedge, of course, we know it's going to happen at the close, not within the day. So they know that they have to pay attention that there could be a trade coming up at the close of the cash, so at 4 p.m. For the others, there is usually a warning. If not, it's on a stop. Like if we take the momentum, it's on a stop. Only exceptionally, it will be on a limit or at market. With the bias, same thing. It's going to be a warning first and then at market. Occasionally, it can be on a stop, like today, for example, but it was not elected.
And I found the link for the Striker Enigma page. I put it in the chat.
Okay. Super. Okay. Fine.
Very good.
Any more questions?
I don't see any.
Okay.
All right, I guess we should wrap it up. Look.
Absolutely. Well, thanks a lot for your attention and questions. And if there is anything else you want me to discuss during the next roundtable, just let me know.
Absolutely.
Send me a message through the Iromir forum or one of the question tabs.
Fantastic. All right. Well, thanks again. I'll end this and get the recording posted, and I'll have these links to Striker and the recording too.
Okay, super. Thank you, Tom.
All right. Thanks, Luc. Thanks, everyone. Yep.